If I had to start my investing journey from scratch, this is what I would do. So you probably heard many times throughout your life, invest in the stock market. It's a smart thing to do. But what is the stock market even? What does that even mean? Well, luckily you don't have to be intimidated. You clicked on the right video. I would absolutely invest in an S&P 500 ETF, exchange traded fund. Now the S&P 500 is one of the most popular, if not the most popular market index out there. Other funds often measure their performance against this index. Warren Buffett, widely considered to be the greatest investor of all time, once said in 2017, consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, especially through thin. The S&P 500, or Standard & Poor's 500, tracks the performance of the 500 largest publicly traded companies in the United States and is considered to be one of the best representations of the overall US economy. The S&P 500 represents about 80% of the total investable US stock market. In order for a company to be included in the S&P 500, it must adhere to certain criteria. The market cap of the company must be greater than $18 billion. Now, market cap is basically calculated by multiplying the share price by the number of outstanding shares. The company must also be traded on a major US stock exchange, such as the New York Stock Exchange. The sum of the earnings of the company in the previous 4 quarters must also be positive. Because of these strict rules, the list of companies on the index may change over time. The companies today on the index are not the same as they were 10 years ago, 15 years ago, 30 years ago. So what's cool about this is as companies come and go, you will always be invested in the best ones. Just watch this video on YouTube of how the top 10 companies on the index changed from 1919 to 2024. Cool, right? So let's see how much money you would have today if you invested into the S&P 500 in various points in history. Okay, cool. So I'm currently on the officialdata.org website, and let's see how much money you would have today if you invested $100 into the S&P 500 in different points in history. So if you invested $100 in 2023, you'd have around $136 today, which is a return on investment of 36%. Or 24.24% per year. Now this is very good, as the average return per annum historically have been around 10%. Let's see how much money you have today if you invested 10 years ago. So you would have almost $350 and a 250% return, or 12.7% return per annum. Let's check 20 years ago. You would almost have $700 or a return of almost 600%. And 9.89% return per annum, which is more in line with the historic average. If you invested $100 30 years ago, you would have about almost $2,000 today, which is a return of almost 2,000% and 10.27% per annum. So the trend is if you invest for longer, you will have more money in the end. Let's check if you invested in 1960, how much money you would have today. So wow, if you invested $100 in 1960, you'd have over $55,000 today, which is a return of over 55,000% or 10.3% per annum. So, this only highlights the power of compound interest, right? So basically the main message is the longer you invest, the more money you'll have in the end. So as you can see, the longer you invest, the more money you'll have in the end. Compound interest is, after all, one of the wonders of the world. And these amounts are only once-off amount. Imagine if you consistently deposit money into the ETF, how rich you'll be. So before we go any further, please remember that none of my videos constitute as financial advice. I'm not a financial advisor. So if you do need financial advice, go speak to somebody that is registered and certified with the FSCA. So if you're starting your investing journey, Easy Equities is a great place to start. The platform is super simple and they have a wide variety of ETFs. They currently do have a monthly fee of 25 Rand for investors who have a Thrive level below 3, which is basically their loyalty program. ETFs are especially great because they offer a wide variety of assets in different sectors, offering diversification, and they're cost effective. So if you look at the S&P 500 Rand-denominated ETFs on the Easy Equities platform, there are basically 4. The Satrix S&P 500 ETF, the 10X S&P 500 ETF, the OneVest S&P 500 ETF, and the Signia S&P 500 ETF. Now these are quite similar. So how do you decide which one to invest in? Well, a good place to start is looking at the TER, the total expense ratio. If you go to each of these companies' websites and search for the ETF, you'll find the TER in the company's minimum disclosure document for the ETF or the fact sheet. The Satrix S&P 500 ETF has a total expense ratio of 0.25% per annum, which means if you invest 10,000 Rand annually, you'll pay 25 Rand in fees, which includes fund management charges, administration charges, etc. The 10X ETF has a total expense ratio of 0.39. The OneVest ETF has a total expense ratio of 0.27. And the Signia S&P 500 ETF has a total expense ratio of 0.2% per annum. Next thing to consider is how dividends are distributed. Now, dividends are basically the portion of company profits distributed to shareholders. The Satrix S&P 500 ETF and the OneVest S&P 500 ETF are both total return ETFs, which means that dividends are not distributed to shareholders on a regular basis, but they are instead reinvested into the fund. The 10X ETF and the Signia ETF, dividends are distributed 2 times a year to investors. So if you need cash throughout the year, the 10X ETF and the Signia S&P 500 ETF may be the better option for you. So aside from considering the total expense ratio and dividend distributions, you should also consider how the fund have performed over time. You can find the returns in the fact sheet, but important to note, those returns usually include dividends distributed. It is also important to note that past performance are not always necessarily indicative of future performance. A higher TER does not necessarily imply a poor return, nor does a lower TER imply a higher return. If you're investing for retirement, you should definitely consider investing inside of a tax-free savings account. I'll probably do a future video explaining more what a tax-free savings account is and what it entails. Also, a super useful website about the ETFs is etfsa.co.za. I would recommend you guys check them out, and I'll post a link in the description. So there you have it. I hope you guys found value in this video, and if you did, please consider liking and subscribing and sharing this video with your family and friends so that they will also benefit. See you guys in the next one.